welcome back. In today's video, we will discuss two important concepts in the world of finance: the cash market and derivative market. This is just a surface level explanation video. There is not much to understand about cash market, but we will discuss derivatives deeply in the next video. So let's start with simple examples to help you understand these concepts easily. Let's start with the cash market, also known as the spot market. This is where financial instruments like stocks, bonds, and commodities are bought and sold for immediate delivery and payment. Imagine you are at a local grocery store and you see apple for sale at $1. You decide to buy it, hand over $1 to store owner and walk out with the apple. This is similar to how the cash market works. In the cash market, when you buy a stock or any other asset, you pay full price and the ownership of asset is immediately transferred to you. Likewise, when you sell an asset, you receive payment and the buyer of the asset becomes new owner. Now let's move on to the derivative market. Derivatives are financial contracts that derive their value from an underlying asset, but no actual ownership of the asset is involved. Think of it like this: you are excited about the upcoming apple harvest and you want to secure the current price of apples for delivery in the future. You approach the farmer and make an agreement to buy 10 apples at $1 each after 2 months. In this scenario, you have just entered into derivative contract. The value of this contract depends on the future price of apples. If the price of apples rise to $1.20 in 2 months, you have made a good deal because you can still buy them at $1 each as per your agreement with the farmer. The derivative market includes various types of financial instruments. Most common is futures and options. A futures contract is an agreement to buy or sell an asset at a predetermined price on a specific future date. In our example, it was an agreement to buy apples in 2 months at $1 each. An option contract, on the other hand, gives you the right but not the obligation to buy or sell an asset at a predetermined price on or before a specific future date. Going back to the apples example, if you had an options contract, you could choose not to buy the apples after 2 months if the market price is lower than $1. Derivatives serve essential functions in the financial markets. They help manage risk and provide opportunities for speculation and hedging. For instance, farmers can use derivatives to lock in future prices for their crops, protecting themselves from price fluctuations. Investors and traders can also use derivatives to speculate on price movement without actually owning the underlying asset. Let's recap the key differences between the cash market and derivative market. First, in cash market, actual assets are bought and sold for immediate delivery and payment, while in the derivative market, contracts are traded based on the future value of an underlying asset. The cash market involves ownership of assets, whereas derivative market does not involve actual ownership. The cash market is focused on the present, while the derivative market deals with future agreements. So that's it for today's video. A simple explanation, a simple basic level explanation of the cash market and derivative market. The cash market deals with the immediate buying and selling of assets, while the derivative market involves financial contracts and agreements based on future value of an underlying asset. In next video, we'll cover futures and options concept very deeply. If you found this video helpful, give it a like and subscribe to this channel for more valuable videos like this.